I would say that it's probably the signal for us, in any case, that this entire cycle, the downswing in global output, the tightening financial conditions by the world central banks in order to contain rampant inflation, that whole cycle that has put really strong downward pressure on risk assets, both in the fixed income world and in the equity growth world, is coming to an end. It looks really probable now in our research and in what we're measuring that sometime in the next quarter, we're going to get a bottom in that cycle, and that actually the outlook will begin to improve quite substantially. It looks as if we're still going down in terms of economic output worldwide. We're still going down slightly faster than before, but that within a month or two, the downward let's say, deceleration in activity and in potential earnings will be slower. And that probably by the end of next quarter, according to our research, that it'll actually will begin to go sideways, which would be quite good news for risk assets.
Okay. The basic premise upon what you're basing it on was at the start there about central banks just slowing their activity. John, we've just had the highest increases in shelter costs in the United States since 1982. Why on earth should they take their foot off the pedal on inflation? As Carl Icahn put it, that is the root of all evil if they do that too prematurely.
Yeah, I would agree that inflation is the key element for a central bank, and that maybe the root of all evil would actually be deflation, if I had to think about what destroys financial systems and what has really created huge problems for economic structures like current economies. But I would say that there are certain lags that are involved in inflation, and that it may be that let's face it, we had out of China about 2.5 years ago a viral event that affected the U.S. economy. Of 130 million people working in the private sector, 20 million lost their jobs in a space of about 3 weeks. The Federal Reserve, all the authorities had to respond, which they did, which meant by September, a lot of the damage had been contained. It was the shortest contraction in U.S. history. On the other hand, they were slow to rein in the money supply growth, which hit 20%, even though an economy which had fallen 10, rebounded 10, it left you a 10% excess money supply growth in 2020, September. And what did we see? In 2022, we had nearly 10% inflation. It is, I've looked at the research, worked on this, Milton Friedman, Anna Schwartz. Inflation is everywhere and always, that's the quote, a monetary phenomenon. But the lag is 18 months to 2 years. You can have different prices going up. One will push another one out, but the overall price level seems to be a function of excess money supply. And that has been taken entirely out of the system. Actually, we have negative money supply growth in the U.S. year on year for broad money. It really doesn't come about very often. And the implications is that perhaps not this year, but the end of next year, the Federal Reserve will be worried about falling prices, not rising prices. So yes, we have to have inflation under control. Yes, you need a central bank that ensures that all the economic participants have a functional banking system and credit system. But it's not a current. I think what's been done already is enough to take inflation low enough so that it appears to be under control.
John. Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.